What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to our 3 stocks on sale series for the month of March 2024. Now, in each episode, I pick 3 stocks that I feel are looking attractive at today's prices for the long term. To make it a little more fun and interesting, I also specifically choose one lower risk, one medium risk, and one high risk option for some added variety. Now, this month in particular is going to be a little different because instead of our high risk option, well, I'm actually going extremely high risk. So I'm warning you beforehand. As always, guys, please do your own research and make your own decisions. In fact, the high risk option for today's video should probably be avoided by most people out there. It's more of just like a speculative gamble that I'm kind of taking a chance on. I just bought a very tiny amount of it today because it actually crashed on the day that I'm making this video on Friday. And so I decided to just make a tiny little speculative gamble on it, and I want to share that with you guys. Once in a while, I like to throw in some different kind of wild stocks at you guys just for some added variety, make it a little funner. And I hope you can appreciate that. If you do like that, please hit that like button and subscribe. But this is going to be a very fun episode because 2 of the stocks on today's list are stocks that I've never covered before on the channel. So I can't wait to share all of these with you guys. But with all of that said, let's just go ahead and jump straight into it. All right, so starting with stock number 1, this will be our lowest risk option. And it's also the only stock this month that I've actually ever covered before. In fact, it's one of my own stocks that I hold in my own portfolio, and that is Extra Space Storage, ticker symbol EXR, which is not only my favorite REIT in the entire market right now, but it's also one of my newest additions, which I also recently added to our community portfolio as well because of the very strong business, the low stock price, and the amazing dividend. Now, on the business side of things, EXR is a self-storage property owner, which is really a service that I think people will always need, especially here in America where cities have just become more and more crowded. And so with that limited space, using self-storage facilities can be a great way of affordably decluttering your home or even business, and especially with the rise of remote work, which I do think much of that is here to stay, resulting in people just needing that extra space at home, pun intended. In fact, demand for storage units has only ever increased over the years, which you can see on this chart here. And because EXR has already spread across more than 40 different states to become the largest in the country by square footage, which is also a market that still has a lot of room for growth and expansion even at their already large size, well, it's resulted in them having very large and stable financials over the years, with sales soaring by over 20% in 2022, 30% in 2023, and still another 12% expected this year as they continue to benefit from the large acquisition of Life Storage before they finally correct back down the year after. But even just in general, EXR tends to lead their peers in both same store revenue growth and funds from operations growth, which is a really important profitability metric for REITs. And yet, because of high interest rates and other macroeconomic headwinds, REITs have actually been getting punished all across the sector. However, I actually think EXR is better positioned than most, especially those in office real estate, where I think EXR actually benefits from the weaker demand there. And so overall, I just think they have a stronger business in a higher demand market, resulting in stronger and more stable cash flows, profit margins, and also occupancy rates, which currently sit at around 95%. Not to mention the strong balance sheet too, so it's just simply not the same situation here as other REITs out there in the market that are dealing with bigger issues. Yet the stock price has fallen by close to 40% from the top, which has lifted their dividend to the highest yield in over a decade at over 4.5%. That's very attractive for a company like this, and I just feel like I want to keep buying this one at these levels while I still can, because I think it's a great, very solid long-term dividend stock, at least in my opinion. Moving on though to stock number 2, well, let's increase the risk a little and go with another dividend paying stock, but one that I've actually never talked about before on the channel, and that is Air Products and Chemicals, ticker symbol APD, which I do feel is a little riskier because of recent struggles. However, it's still very dependable long term, and I've actually had this one on my watch list for a couple years now, really waiting to see if it ever dipped down to a more attractive level, which we'll get into that in just a second. But if you've never heard of this company before, they're one of the largest producers and processors of industrial gases in the entire world, serving over 30 industries for oxygen, nitrogen, argon, hydrogen, helium, and many other specialty gases. The company now has over 750 production facilities worldwide across 50 different countries and is even the #1 supplier of hydrogen in the entire world, which we'll come back to in just a second too. But so as you would expect, this is really a business here that is relatively stable in that there's a lot of cost involved for creating and managing all of these different plants and facilities, and just the overall supply chain of it too, which makes it really hard for new competitors to enter the space or dethrone a giant like APD. It's kind of a big barrier to entry for their market, and as such, their financials tend to be pretty strong and reliable, which is where the lower risk comes from. However, growth can be a bit limited, especially due to the heavy exposure to China, which has been going through a macroeconomic slowdown, especially in manufacturing. And so that's really where the risk comes from, as they're pretty heavily exposed to the global macroeconomy, which we all know isn't looking very bright these days. When speaking about it, an analyst from RBC Capital Markets noted that guidance is looking soft for most large industrial companies, with many of them flagging weak economic growth in China as a primary concern. Although he did at least say that the slowdown will likely be manageable for most of these companies. But regardless, sales for APD are now expected to be about flat this year before rebounding to a high single-digit growth rate the year after. Still, like I said, this is a leader in the space that is very hard to knock off. So seeing what is normally a very reliable and strong performing stock suddenly lose more than a quarter of its value is pretty tempting for me to finally jump in, especially given the rising dividend to above a 3% yield, which also carries some excellent growth metrics on it too, like nearly a double-digit growth rate and over 4 decades of consecutive increases. The valuation isn't too great though, still a bit higher than the sector, but it has at least fallen around 20 to 30% cheaper than their own 5-year averages for both their PE and PEG ratios. The stock is also trading significantly lower than the average analyst price target, and while there are certainly some concerns over how much the company can grow in this current macro environment, I actually think some of their recent investments are looking very promising for the longer term future, especially in chip manufacturing, which uses a ton of helium, as well as the green energy transition economy, which will use more liquid natural gas as well as nitrogen. Both are giant markets that APD will continue to be a leader in. In fact, hydrogen is estimated to grow from less than $200 billion this year to more than triple that size by 2030, reach almost $1 trillion by 2040, and then start closing in on $1.5 trillion by 2050. This is a huge opportunity for APD to capitalize on, and so that's exactly what they're doing, with spending increasing to as much as $5.5 billion this year, with a total planned investment of $15 billion through 2027 on just clean energy projects alone. One of which, by the way, is in building the largest hydrogen plant in all of Europe, which will be built, owned, and operated by APD themselves. So if you add all of these details up together, what I think that we're really left with here is a giant leader in a market that I think is only going to grow larger over time, but that the stock is being dragged down because of macroeconomic issues here in the short term. But longer term, I think this is a dividend beast here that should probably be owned in most people's portfolios. And I don't own it yet, but I am extremely, very heavily considering picking up some shares right now, and I might do so here in the coming week. With that said though, that's going to bring us now to stock number 3, which is the high risk option. And like I said before, this is actually going to be an ultra high risk stock. So you've been warned, guys, this is more of a speculative gamble than anything else. It's kind of like going to Vegas, but in my opinion, a little bit more fun and maybe easier too, just because it involves stocks. So I love to kind of take a chance on one of these once in a while. But yeah, this is actually going to be a bank stock, and a lot of people are actually worried that it could potentially go under, like several others have recently too. But I feel that if they manage to stick around, we could be left here with an extremely attractive valuation and dividend. And that stock is none other than New York Community Bancorp, ticker symbol NYCB, who on the day of making this video crashed by over 20%. So I decided to buy a very tiny amount at right around that same price. But this now leaves this stock down over 70% in the past 5 years after getting absolutely decimated from the top. And there's several reasons for this. Now, the first thing that you really should know about NYCB is that they've been trying really to transition themselves in recent years from just being a small regional bank into a much larger, more diversified commercial bank. See, a large portion of their portfolio is in multifamily real estate, which includes a lot of rent-controlled properties in the NYC area, which limits their growth, as well as a large concentration of their loans being in office buildings, which again are probably the most affected or troubled type of real estate in the market right now. And so one of the ways that they've been trying to transition and kind of diversify themselves away from some of these other types of assets has been through strategic acquisitions, having already made 13 of them since 2000, including a couple recent and very large ones in 2022 of Flagstar, which increased their assets to $88 billion, as well as this sort of fire sale buying of specific assets from the failed Signature Bank during the 2023 bank runs that caused several banks to fail, which was not only an opportunity that NYCB would have otherwise probably never received given the recent crackdown by regulators on large bank mergers, but it also allowed them to basically cherry pick only the specific assets that they actually wanted, which also helps with that strategic plan of diversifying that I mentioned earlier. In all, it was more than $30 billion of assets, including all of their branch locations too, which brought NYCB up to over $100 billion in total assets. Now, on one hand, this is a great way of setting themselves up for larger growth opportunities in the future, but on the other, NYCB had many bad loans on their own to begin with, which after adding on certain impairments and goodwill write-downs from the acquisitions, well, they actually suffered a large drop in profits last year despite growing into record sales that were more than double in size. See, when a bank grows into more than $100 billion of assets, it gains more regulatory oversight and scrutiny from the Federal Reserve, which resulted in them finding tons of issues, many of which date back to as much as 15 years ago and don't even have much to do with the new acquisitions either. But regardless, it's resulted in lots of goodwill write-offs and restructurings, including not just the heavy losses that made them miss earnings, but it also forced them to cut their massive dividend by 70%, which the new CEO noted as a necessary move to now strengthen their balance sheet given all the new changes. Oh, and that new CEO, by the way, was just appointed a few days ago after the company reported that they found material weakness in tracking their commercial real estate loan risks, resulting in a $2.4 billion goodwill impairment charge, although that's related to transactions from many years ago. But regardless, you can clearly see just how much of a transitionary period this bank is really in. With all of that said, though, the reason why I'm personally taking a very small chance on it is because once they move past this period, assuming that they can survive it, well, I actually think that we may see the early stages of a new growth trajectory for an extremely beaten down stock here. I mean, the valuation is of course dirt cheap now too, with a trailing PE ratio of only around 1 and a price to book ratio of just 0.2. For context, the sector median and even their own 5-year averages of PE ratios is typically more around 10 or 11, which is like 1,000% higher. And even after the dividend cut, it's still yielding over 5.5%, which is like close to double the sector median. And by the way, they've paid dividends for decades, and the attractive thing about it now is that it might actually be sustainable after the recent cut and may even gain a growth trajectory going forward too if they can kind of stabilize their business. Plus, for as scary as their business is right now, and after the acquisitions, considering the recent bank failures, well, I would argue that most of the failures were actually due to extremely high levels of uninsured deposits. But NYCB has levels that are actually pretty normal, with more than 70% of total deposits insured and 90% for the top 20 deposit relationships as well. And even most of the uninsured ones have reciprocal agreements, which their high liquidity also easily covers at a coverage ratio of 163%, or nearly 9 times the amount if using the reciprocal capacity, which would raise insured deposits up to 95%. Plus, their balance sheet has also gotten a lot stronger, with now $17 billion of cash that could likely grow even larger now because of the dividend cut. I also like the new CEO, who was actually named CEO of Flagstar back in 2013 when that business was a mess, and he did a great job of cleaning it up, which I think that he can do a similar thing here with NYCB too. And already he's been praised a lot online for making smart decisions and appointing new executives to key roles. Again, though, this is a very speculative gamble here. It's not meant to be treated as like an actual investment. But in my opinion, it is a little bit better odds than just going and gambling at the casino. And so I like to take a chance on these once in a while. And, we're always so cautious with this channel that I feel like sometimes it can be a little fun and maybe entertaining for you guys if I kind of spice it up a little bit, think outside the box, and throw something a little more random at you guys. And so I hope you can understand that. I might get a little bit of hate for this one, but I think a lot of people might appreciate the fact that I'm throwing something new at you guys. And if you do, then please consider hitting that like button, subscribing. It really means a lot. And thank you so much, everyone, for all your support. It means so much to me. I hope you're all doing well. And make sure you leave your comments down below and let me know if you agree or disagree with anything I said today. But yeah, that's going to do it for today's video. I hope you enjoyed it, and I will catch you in the next one. All right, take care, everybody. Bye-bye.